but if I had a gun to my head, I would tell you that it should be a hell of a lot higher based upon what we see in the world right now. And the fact that it's not is a testament to the Western ability to control the narrative until they can't. And I've been very fond of a term called logarithmic decay. Little by little by little by little by little by little, then bang, all at once. That's how Hemingway went broke. Little by little, then all at once.
Welcome back to Soar Financially, everybody. Thank you so much for joining us here for yet another exciting discussion. I'm joined in a few short moments by Andy Schectman. My name is Kai Hoffman. I'm the EdJR mining guy on Twitter and the CEO of the Soar Financial Group. I've said it so many times, I'm stuttering now. Apologies for that. But we have some really interesting topics lined up and really timely topics lined up for you today, as we're going to discuss like what pushed gold and silver prices higher. And I think we should really focus on gold, because my gut tells me, and Eddie might correct me, gold has been more violent in its move, for lack of a better term, and more dominant in that move. And that's just my perception. Andy, I'm sure, will fill us in on how he feels about it. But some of the other great minds in our economy, or great minds, or CEO of banks, have really chimed in the last 24 hours and made comments in the last 24 hours that we definitely need to discuss. One is Bill Ackman. He closed his bond short just recently, and all of a sudden bond yields started to decline. That is interesting. But also Jamie Dimon just today in Riyadh at a conference mentioned that the Fed has a really poor track record of sort of forecasting the economy, and that it's dangerous to lock in a certain forecast without adapting, talking about probabilities and possibilities. So really, really good stuff. And then I just found a really good article on Wall Street Journal talking about Black Monday and whether that's looming again here, talking about October. And that was October 1933, so 90 years ago. So if you like this content, if you like what we're going to discuss, and if you have any comments, put that down below, subscribe to the channel, and now let's dive in. Andy, welcome back on the program. It's great to see you. Long-winded intro, but I think it needed to be said.
Yeah, no, it's all true, all good stuff, Kai. Good to be back, buddy. Always a pleasure.
Absolutely, yeah. Let's dive right in, because I took way too long for the intro here, but we have a lot of stuff to discuss today. And let's really start with gold. I want to start with gold today. We've seen a really impressive move, I have to say, from 1810. Seems to be a technical level there, and it's technical support at 1810 to now 1960, 1970. We're close to 2000 at one point. What pushed gold higher here? And is it just geopolitics, Andy?
And gold should be a whole hell of a lot higher than it is, Kai. That's the truth of it, is that you have, over the last 18 months, not only the wealthiest, most well-funded, but also the most well-informed traders on the planet accumulating gold at record levels that no one's ever seen before, and that being the central banks. And when you have massive central bank purchasing, I think it certainly is one big reason why gold has held up well in the face of supposedly real rates being positive. And I would argue that that's really not true either, because first of all, gold and real rates are supposed to move inverse of each other. That's called Gibson's paradox. But I think the market understands that the inflation metrics by which the CPI gauges rising costs is flawed, that real interest rates are still negative. But what you are seeing, I think, is a realization. Look, for the first time in 45 years, U.S. Treasuries now have a higher downside volatility than gold. Okay? And another way of saying that is that Treasuries are no longer the safest alternative. And that's a very, very damning statement, because the Treasury market has always been considered the safest, most liquid market on the planet. And when measured against performance, for the first time in 45 years, gold is now considered a safer, less volatile investment than U.S. Treasuries. Think of the Tier 1 revision of gold now for a moment, where prior to July or April of 2019, since the end of World War II, there's been one Tier 1 reserve asset for central banks. That's been U.S. dollars and U.S. Treasuries. Well, a couple of years ago in 2019, the BIS, the Bank of International Settlements, quietly reclassifies gold as the only other tier one reserve asset, and the acquisition of gold by the central banks using the Western market suppression, the paper market suppression, has enabled them, even with the suppression of paper, to drain the cupboard so much of investable silver that the price is rising. And again, I think that it is the central banks and their purchasing that has certainly put a floor underneath the price of gold. But if I had a gun to my head, I would tell you that it should be a hell of a lot higher based upon what we see in the world right now. And the fact that it's not is a testament to the Western ability to control the narrative until they can't. And I've been very fond of a term called logarithmic decay. Little by little by little by little by little by little, then bang, all at once. That's how Hemingway went broke. Little by little, then all at once. That's what you would experience if you were on the Niagara River approaching the falls. And so the bottom line is that this is a situation where the biggest money in the world understands where we're going. They are using the suppressed and massively over leveraged Western paper market system to run cover for their repositioning and de-dollarizing, enough so that it is actually able to allow gold to quietly rise. I mean, look at it this way as well. You look at last week, gold hit its all-time high against the second and third largest economies in the world, in China and Japan. Gold is at all-time highs against most currencies. It's the fact that the dollar, being the cleanest shirt in the dirty laundry hamper, is blurring gold's role as being a safe haven asset in times of instability. The rest of the world understands that people in this country have been blinded by a dollar that is irrationally strong until it's not. And certainly seeing the fact that the first time in almost 50 years that gold is considered less volatile than the treasury market, this is a phenomenon that I think might wake up certainly the people in this country sooner than later.
A lot of short squeeze, or I would not a lot of short squeezing, but short covering going on in gold in recent days. Here's in the last 19 days. Looked at the chart a little bit here, and it seems like post BRICS meeting in Johannesburg, that was midsummer. Gold has been under pressure because it was hyped up tremendously. It's like, oh, the BRICS might introduce a new currency. I think we talked about that as well, Andy. But then some of the air was left out of the balloon here, and the market and gold price has just been hammered because the news didn't really substantiate, or the rumor didn't substantiate here as well. Do you see a trend change now completely? The short covering, is there any fundamental change? Like, because what you just described, like, it has been going on for a while, obviously, ever since the Fed really started raising rates in March 22. Has anything changed really? Like, it seems like you're sort of stating the obvious here, Andy.
Yeah, but I think the problem in this country is that people think in terms of events like that, or days or moments. Oh, crap. They didn't issue their gold-backed currency that Jim Rickards talked about. And so what? I mean, the other group that talked about it was the embassy in Africa, the Russian embassy in Africa. So what? Jim was wrong. He'll be right. And I think that they realized that in order to issue a currency to gain legitimacy, you have to have a large enough block. 27 countries have applied to BRICS. There will be more and more countries that sign on before next year's meeting, substantial countries. And in order for a currency to work, think of Bitcoin. Well, what did everyone say Bitcoin needed to work? It needed adoption, mass adoption. So having 11 countries now in BRICS is certainly better than the 5 that there were prior to the August meeting, as we brought in 6 new countries. And if you look at the countries that were brought in, by the way, it's very obvious their thinking. You have Argentina, who's got the largest natural gas deposits in South America and controls the Straits of Magellan. You have United Arab Emirates, Saudi Arabia, Iran, who, big OPEC producers, huge oil producers. They, along with Egypt, controlling the Straits of Hormuz, massive oil pathway there. And you have Ethiopia, the largest, fastest growing economy in Africa, that is rich in minerals and metals and rare earth metals that are needed in battery operated vehicles and whatnot. They are building alliances methodically and doing it the right way. The Chinese think in terms of decades, we think in terms of minutes. And oh crap, they didn't sign it. Well, forget it. No, actually, what happened was that they were tasked. First of all, they agreed to trade with one another in local currencies until next year. And you're seeing that over and over and over and over again. You're seeing these countries that are trading with one another using local currencies. And then they also said that they would come back next year. They were tasked, the finance ministers were tasked with going back to the drawing board, coming back with proposals to unite a common settlement currency. But when we talk in terms of what they're doing until then, look, we talked about a few months ago, Brazil struck a deal with China, the second largest exporter of corn in the world. Brazil said, we'll sell you our corn and we'll take yuan for it. And now China is buying soybeans from Brazil and paying for it in yuan. And sales to American farmers has decreased by over 40% over the same period. They're not buying them from the US farmers in dollars, they're buying them from Brazil and paying in yuan. And this is the little by little by little by little, this logarithmic decay that I've talked about. I could give you 100 examples of how this is happening, how countries are trading with one another in local currencies. Even our allies, like France, just bought a massive amount of liquid natural gas from the United Arab Emirates, paid in yuan. So we are witnessing a transition away from the dollar where all of this settlement outside the dollar will eventually affect the reserve status of the US dollar, and not until they have a block substantial enough in size will they come out and flip the switch, which could very quickly reshape the global landscape in a matter of seconds. I mean, look, you have Saudi Arabia, the linchpin of the dollar hegemony, now is in BRICS and has signed up with the Shanghai Cooperation Organization, told everyone they'll take oil and other currencies. This is just the very beginning. And when the switch is flipped, they will have to use something to peg to a new system to gain immediate credibility, transparency, and integrity. And that's what gold will do for you. That's what blockchain technology will do for you if done the right way. People say, well, who will trust China? Well, who the hell trusts us anymore? I mean, look at the things that are happening in this country. And I would argue that the Fed realizes that now, that the bond market is bigger than they are, and that the market rates are rising because it is a lack of trust in this country and in the faith of this country. And I think that's beginning to erode, and you're seeing bond yields rise as a result of it. And I don't care all the movements or manipulations in the world that the Fed thinks that they can intervene in a market as big as the US bond market, when the rest of the world says we've had enough of your massive debt accumulation, we've had enough of your wars, enough of your hypocrisy, enough of your coercion, enough of your meddling. And by the way, you're going green. You don't need oil anymore from OPEC or Saudi Arabia. So we're all joining this new union that represents the majority of humanity, and it's not going green. And we don't like the way you're doing things anymore. So that's it. And I think it's a very simplistic way of saying that's kind of the big picture. And little by little by little by little, it changes until bang, the dollar is no longer the sole settlement currency, and gold is backing a new system. So for those people who look away from gold because of this moment in time in August where the BRICS said, well, let's pause a little bit, we'll come back next year, do it the right way, instead of shotgunning it the way the US does, reactionary. No, let's do it the right way. Let's have a big enough group of people with enough influence and enough control of the global commodity structure where it really makes sense when we flip the switch. And so, if anything, this is a gift for those people who haven't yet realized where we are and where we're going. And I would simply say this, Kai, that if it were just price, fine. Okay, it doesn't make sense. It's counterintuitive, but that's exactly what they're doing. That's why they are taking advantage of the manipulated, over-rehypothecated, over-leveraged COMEX and LBMA price setting system that allows them to pickpocket the world's commodities, whoever's dumb enough to let go of them at these prices. And that's why they're not bitching. Once they own it all, I think what they will do is they will move the price setting mechanism to one of two places, either Abu Dhabi in the United Arab Emirates, who has joined BRICS, or the Shanghai Gold Exchange. And the COMEX and the LBMA will be exposed long before that for what they are, a rehypothecated leverage system, where right now, today, there is 1,600, almost 1,700% more paper contracts in the silver market than there are bars behind it. Do you see a problem there? And at some point, this just becomes too big for the Fed to handle. And you add on top of it, the big banks around the world, China and Saudi Arabia and Japan, they're dumping treasuries. So you have treasuries being sold, you have interest rates rising, you have a banking system that's on edge. You know, you have all of this stuff happening all at once. People should be flocking to gold. And what blurs it and what throws them off the scent is the fact that you can rehypothecate, you can manipulate and distort the commodity structure so much so that people don't notice it, except the people pulling the strings, and they're the ones buying it at pennies on the dollar.
Oh, fantastic commentary there, Andy. And I feel like my questions are almost too micro focused. Like, because I was going to ask you, like, maybe I'll ask you about the U.S. economy, the state of the U.S. economy, because one of the reasons Bill Ackman closed his bond short was that he doesn't trust the economy anymore, and he doesn't believe that the data is properly forecasting and telling the true picture here. Do you agree? And what is the state of the economy, if you want to humor us here?
Well, I mean, I'm surprised he closed it, to be honest with you, because I think interest rates will only go higher. And maybe there were other motivating factors behind it. I mean, if he's short bond prices, he's expecting yields to go higher. And if he closed that out, I'm shocked by it, actually. I think the economy is in a very, very, very bad position. I mean, you have record high consumer debt, over 17 trillion, I believe. You have record student debt, 1.6 trillion, which, by the way, is the largest asset of the US government. 43 or 4% of our asset base is student debt. 5 trillion in assets, 1.6 trillion of it student debt. They actually consider it to be the largest single asset of the US government. Google it. We have 3.5 trillion assets. You take away student debt, backing 155 trillion in debt. Not a good picture. We have record auto debt. We have record credit card debt. We have 65% of the country living paycheck to paycheck. We have 45% of the country making over $100,000 a year living paycheck to paycheck. We have, for the first time ever, we have, you have to have $114,000 in annual income to afford a typical house in the United States, up 90% from 2020. It was 60,000. Now it's 114,000. At the same time, we have mortgage rates that have gone from 2.6% to 8% as house prices have gone up 30 to 50% or higher. We have a banking system that is completely and totally over leveraged and undercapitalized, where a company like Bank of America can issue $131 billion in unrealized losses on their balance sheet here in the third quarter. 131 billion, and the market doesn't go nuts on that and short the hell out of that stock. Not to mention they have $82 billion in precious metals derivatives, including what Ted Butler believes 32 billion of that is a billion ounces short in the silver market. Why are they short gold and silver like this? Do they know something we don't? Are they being told to suppress the price of gold and silver to make the dollar in the Western system appear stronger than it is? We have lawlessness in our cities. You know, San Francisco, Philadelphia, New York City, take your pick. We have divisiveness in this country, where people are divided, not unified whatsoever. And, you know, it's a situation where I think this economy not only is undercapitalized, over leveraged, very, very ununified. We are very divisive. And I don't think people have any idea what's coming down the pike. So I am surprised that he did that, because in my mind, interest rates have nowhere to go but higher. I've had lunch the last few days with three guys that own successful businesses, and not one of them knew what a bank bail-in is. None of them. And I believe you will see a bank bail-in yet this year. You will see another bank fail. It will be bailed in, as Janet Yellen has told us, as it was written into law in the Dodd-Frank Act in 2009. And this is why there was so much outrage when Silicon and Signature were bailed out. Well, they were too systemic, she said. Too systemic would have brought down the system. The next bank that goes will be bailed in, and you will see a whole bunch of people understand how underprepared we really are when they lose everything above the FDIC limit of 250,000 as an unsecured general creditor. So this economy, I believe, is far, far, far worse off than we are being led to believe. In fact, if they hadn't already changed the definition of recession, we would be there. One other comment I'd like to make, you mentioned something earlier about rates rising on the back end and what it was like and when the markets collapsed previously. Everyone talks about the fact that the yield curve is uninverting, where typically that's when you can expect to see a recession. It's been inverted forever, which typically for the last 50 years has always been the precursor to a recession. And it's not until the curve uninverts that we see that recession. But normally that uninverted curve is because the Fed comes in and lowers short-term rates to stimulate the economy. But that's not happening. In fact, short-term rates are going higher. It's the back end of the yield curve that is rising too fast for them to compensate. That's what's uninverting the curve. It's that for the last year or two, you get paid way more in a 6 month or a 1 year treasury or a 2 year treasury than you do in a 10. That's not right. It's supposed to be opposite of that. The longer you lend out the money, the more return you should make. That shows that the market has been expecting, because the economy is supposed to get so bad that the Fed will come in and they will pivot and start to lower rates again and inflate. But that's not what's happening. What's happening is that no one wants to take the long end of the curve. No one wants these longer maturity treasuries because there's too much risk and uncertainty surrounding this government and this economy. So the rates on the back end are rising as the countries around the world are dumping those longer maturity treasuries. So this is a bad situation where you have rising back end and a rising front end, coupled at a time when people don't have the ability, no savings, and massively in debt. As the economy slows down, you'll see cracks in commercial real estate first, then in residential real estate as people lose their jobs, and the banks will. There are so many points where this thing could explode, and people talking about positivity and soft landing. I think their head is so far buried up the ass of recency and normalcy bias that they can't see what's really happening. So I'm surprised Ackman did it. And quite frankly, if I had to guess, rates will go much, much higher. And I'll tell you something, I believe it's planned. There you go. I believe it is planned. And if it weren't planned, then you wouldn't be allowing the reverse repo market to put money market funds into it, which is sucking all the money out of the regional banks. And now the Treasury is putting rates higher than the reverse repo market. So all of that money is getting sucked out. That's the big money that is going directly to the Treasury. The banking system is being bled dry. We are losing liquidity. The repo market is being bled dry, which is the vehicle for liquidity for businesses and corporations. The economy is in big trouble. And when that breaks, because it's a liquidity crisis, as rates go higher and there is no liquidity and people can't continue to operate their business the way they did in zero interest rate environments for the past decade, there's going to be hell to pay. And a 4% mortgage on $500,000 is great until you lose your job. And I think we haven't seen anything yet. I really, truly believe that. And I wish to God I didn't feel this way. But the decisions by our policymakers, if you look, and we've talked about this before, the number 1 and 2 advisors to the US government, one is a modern monetary theorist, wants to get rid of the banks, wants to go central bank digital currency. And the other one The number one economic advisor of this country, Jared Bernstein, has a degree in music and a master's degree in social work, wants to lose the world reserve status. That's his stated platform. It's a privilege we can no longer afford. And you look at what he's done around the world, what we've done around the world by weaponizing the dollar and pushing away the linchpin of the dollar hegemony, Saudi Arabia. You couldn't draw it up any better. And so you have to ask yourself, could it really be that this stuff is intended? Could we really be trying to reset a system? And now we have a villain to point to, is Xi Jinping and Putin and OPEC. They did it to us. They ruined this whole good game that we had going. It's their fault. But as the world is selling treasuries, who's buying them all? It's us, the public. All that money that's leaving the banking system is ending up in treasuries. And so all of this debt, the unfunded liabilities, Medicare, Medicaid, Social Security, government military pensions, 130 trillion, it's owed to us. The majority of the debt is owed to us, not to everyone out there. So if you do want to reset the system, blow it up and have a villain to point to, well, it's a whole lot easier to pay back us, because have no fear. It's okay that interest rates went to 20% to compensate for everyone dumping dollars, and the markets collapse and the banks collapse and you own nothing and you'll be happy, as Klaus said, because Lael Brainerd is here with their central bank digital currency, which was signed into executive order a couple of years ago. The BIS says everyone has to have one by 2025. 95% of the countries in the world, or let me put it this way, the countries that make up 95% of the global GDP, almost all the industrialized nations having operational a central bank digital currency in development or in operation. It's coming. Have no fear. Sign on the dotted line, take the CBDC, and we'll make you whole. Could it be that they are incentivizing this collapse, a divided country, in debt country, over leveraged country that was incentivized to take on debt and to speculate, and then bang, up go interest rates at the fastest rate ever? Could it be that this is all being done on purpose? Reset the system, start over, pay back all the Americans in a new system, tell the rest of the world we're sorry, but they did it to us. I don't know. Either that or our politicians are completely and totally stupid. So how do I think the economy is? A whole hell of a lot worse than evidently Bill Ackman thinks it is. And I personally believe that rates will go much higher before they go lower.
Well, lower yields means that people are fleeing into bonds for safe haven investing, but that also means they trust that they're actually going to get their money back if they wait till maturity of those bonds, right? So isn't that sort of moronic? Because especially based on our conversation here, it seems like if there is a collapse, it's the government that will collapse financially from a financial aspect.
That's the thing,
right?
No one believes that it's possible. That's the point.
Yeah.
No one thinks that the US government could ever fail. No one believes that the bond market, look at the bond market. Since 2020, this will go down as the worst bond market in history. The worst, the biggest bear crash in history since 2020, and down over 50%. This is the safest, most liquid investment on the planet. Could it happen? Well, at what point does the debt accumulation begin to become just ridiculous? This is the third biggest deficit we've ever run in 2023. The other two being 2021 and 2022 because of COVID spending. At what point does the rest of the world say it just doesn't make sense anymore? You have a $33 trillion debt and 120 or 30 trillion in unfunded liabilities. At what point does it not make sense anymore? Just because we supposedly have the trust of the world, do people really trust us the way they used to anymore? And when you look at the way other countries are going about this, now I'm not saying people trust China or the BRICS more than the US, but look at the way China's doing things. They're going in a mutually cooperative manner. They are building bridges and maritime channels and roads and railways and oil refineries and gold mines, and they're doing it in a non-coercive fashion. And they're building, they're the adult in the room, striking peace deals between Iran and Saudi Arabia, between Iran and Iraq, countries that have hated each other for centuries. Are now finding safety in numbers where their enemy's enemy is their friend. And the West is beginning to lose significance. When you see China dump more bonds and more US securities than any time in the last 4 years, over the last month, when you see that happening with Japan and Saudi Arabia dumping our treasuries, Saudi Arabia, the least amount of treasuries they've held in the last 6 years, they're dumping treasuries. slowly. And who's buying them all? I mean, who wants to take on our debt when it continues to be accumulated at a pace that is unrealistic and will never pay back? Remember, a trillion seconds ago was 31,688 years ago. At what point does it just become stupid? And I think that's the problem people have, is recency bias, normalcy bias. I think we have very methodically exhausted much of the good graces of our foreign creditors who don't want to hold it anymore. They don't want to hold our debt. So yes, typically that is what would happen. They would run to treasuries, run to the dollar in times of instability. But I mean, it seems like we're at the root of all the instability. And
Seems
our
like you're running
system,
into the burning house, eh?
yes, that's the point. And I think if you're not a contrarian right now, you're bound to be a victim.
Yeah. Now, you sort of touched on it. You didn't go as far, but I sort of expect you to talk about Black Monday in 1933. And I mentioned the Wall Street Journal opinion piece here that was published, I think, a couple of days ago. But it talks about how Fed QT and the higher Fed funds rate sort of puts a kibosh on everything and sort of led to that massive crash of in 1933 as well. And 10-year bond yields rose from 7 to 10% from January to October, for example. M2 money supply dropped. It is dropping right now. It's been the biggest decrease, actually, or most extreme contraction since 1933 here as well. So do you see the similarities? Like you almost described it to a T here. Would you agree? And maybe is that one of the reasons gold ran before the weekend, because everybody was afraid of a Black Monday?
Yeah, I mean, you are seeing, and that's all the money going directly into treasuries. It's leaving the system. The repo market, which is the funding mechanism for a lot of these institutions, is being bled dry. It could be bled dry as soon as January if the rate continues. Over $1 trillion has already been bled dry. And when you talk about, treasury yields rising, well, until Ackman put out that tweet, 10-year treasury had hit 5% for the first time in 16 years. But you got a guy like, what's his name? The little guy on CNBC, which I really
Kramer?
like. No.
It's the only guy on a known CBS.
The bond commentator, and he's really good.
Oh, I know who you're talking about. Let me find that. Yes. He was talking
I
about
actually-
13%, I think. He was talking about
Yeah,
13% bond yields.
13.5% on the treasury market. And, that's what he's saying. He's doesn't have a dog in the right wing fight. He's saying it goes high as 13.5%. So, yeah, I think the bond market, look, rates are supposed to be controlled by the market, not by the Fed. And I think that's what's happening. I think that the markets are beginning to realize that they are stronger than the Federal Reserve is. And then I just see a note by the Federal Reserve coming out and saying that on top of all this, that life insurers continue to face liquidity risk due to the heavy reliance on non-traditional liabilities in combination with an increasing share of illiquid and risky assets on their balance sheet. Well, illiquid treasuries, risky assets, I don't know, mortgage-backed securities. Who wants to hear that with the insurance companies? Remember, in 2008, they had to bail out AIG, or the whole system was going to implode. They are a reinsurer. They haven't learned their lessons. And so, yeah, I think that's exactly what it will be. And it will happen in a way that catches everyone off guard. But look, let's just go back just a minute and say that the suppression of interest rates over the last decade has created massive capital distortions, which created bubbles everywhere, including the bond market. And these distortions are everywhere, including socially and morally, and everything this country was founded upon seems distorted in my mind. And the rise in yields right now, to me, is no longer a function of what the Fed is doing or not doing, but more a function of the loss in confidence in the United States and its ever-expanding deficits. And I think the central bankers are starting to realize that the bond market is stronger than any central bank. Yields must rise until they meet demand, period. And there'll always be demand at a certain yield, but the question is, what yield will those buyers be found? And if not, then what is the central bank just going to buy all the bonds and monetize it? and might as well just go down the road of Weimar Republic at that point. So, yeah, I do think that that's exactly what could happen, and it will happen in a way that is worse than anything this country's ever seen, because of the distortions of suppressed interest rates for over a decade created anomalies in asset prices. Distortions, great distortions, misallocations of resource and capital that has created this environment where when it collapses, it'll be something spectacular because the prices were so far distorted to the upside in an environment where interest rates weren't real, that when interest rates try and find equilibrium with asset prices, it will be a religious experience for most people who have no idea what's coming. And even people who are very well read, Kai, I think, are just reading the wrong things. So they're not prepared for it either.
Interesting, Andy. Let's one last question to sort of put a bow around it, and you sort of hinted at it like within your answers, but I think asking that sort of puts, as I said, puts a bow around it. Is like, how restrictive are the current bond yields and the Fed's fund rate for a higher gold price? And as you're saying, you're expecting higher bond yields to emerge. Like, how restrictive is that for gold going forward? You expect, of course, a higher gold price, but can it go in tandem, or is the yield just too restrictive right now?
In a normal environment, in a country that wasn't besieged with debt and instability and fracture points, the higher the real interest rate goes, the lower the price of gold should go, or the less the demand. That's Gibson's paradox, the inverse relationship between real interest rates and gold. There's something in statistics or math called the rule of 70 seconds. You take the interest rate and divide it into 72, and it tells you how long before your principal doubles. So on a 7% yield on a treasury in 10.2 years, your rate doubles. At 10%, 7.2 years. At 20%, 3.5 years. The thing of it is that this time, I think it comes with great peril in a rising interest rate environment, not only to the markets, which have all been over leveraged due to suppression of Mother Nature, goofing with the math of it. In other words, instead of letting the markets collapse in a way, we came in with QE and QE1 and QE2 and on and on and on, Operation Twist and all this crap, which distorted the real markets and created a ever bigger problem. But the point is this, that this time it comes at great expense to the dollar and the markets. So I think that's why, in terms of how restrictive can it be, what does 20% interest rates say about the safety of the dollar? And what would 10% interest rates in the federal funds rate with, mortgage rates at 17, 18, 19%, what does that do to the economy? What does it do to lending? What does it do to everything that has been over leveraged on the basis of forever low interest rate environment? That was not the case. So I think that this time it's different, because as rates rise, yes, if rates hit a point of 12, 15, 18, 20%, how confident are we in the future of the dollar? And when you look at the BRICS union that is growing methodically, I would say to you this time, less restrictive, because the big money knows the playbook. The fact that it's holding up as well as it is in a rising real interest rate environment right now speaks to that. The higher the rates go, only is going to hurt this economy substantially more. Everything, stocks, bonds, and real estate, which have all been pushed up to stratospheric levels, they're all inversely correlated to that moment. So as rates rise, everything collapses. It's a double-edged sword. They're damned if they do, they're damned if they don't. And I don't think that you will see the demand for treasuries at those higher rates the way we would if none of us worried about the future of the dollar or this country the way that a lot of us are. So your point is valid. And I could be wrong. Maybe this country has always done well when our backs were against the wall, but we were unified then, and we're not now. Look at the riots that are going on and the violence and the lawlessness.
Well, I think just to jump in there, and it reminds me of a Marvel movie, and it's probably a bit grotesque to quote Marvel or But
Oh, it's not.
to fight like a common, you need a common enemy, and I think we've just created that common enemy. Okay,
Yes,
if we want
we
to go
have.
down that road, I think which actually unifies both sides, and everybody can agree that what happened was absolutely egregious or is egregious as it keeps going on, and that unifies people, right?
But not until there is a collapse. That's the point. The unification comes after the collapse because you have a common enemy to blame
okay,
everything upon, and now a rallying cry. But getting to that point is not as easy as it is to talk
like
about it because it will come at great hardship.
no,
So yes,
I,
I
I just
agree
like
with it.
I just like I'm starting to love this. Like, and I'm jumping in here, Andy. Like, apologies for that, but
No, I agree
let's
with you.
assume like I don't want to throw 9/11 in here, but 9/11 also unified the people and gave Bush sort of the go ahead to infiltrate to attack Iran,
Right, and
Iraq,
they didn't find
right?
weapons of mass
Oh yeah,
destruction.
that's a different story, right? But it
Right, but yes,
unified
that's
people and it
right.
gave them, it's like, okay, now I got approval to go do this. Okay,
Right.
so then sort of seems like it's leading that way, but we're getting off topic here,
No,
Andy.
but
We could
it's
we
not off topic, Kai, because with all due respect, it is the topic. And watch one of those Yankee World Series games after you get chills. Everyone hugging and flags and unification, and that's what this country is supposed to be. We're all Americans, and our ancestors came from somewhere, and we're supposed to be unified, and that's what has given us great strength, our common interests and common goals, and we're not. What is the Communist Manifesto? Number one, divide and conquer. We're very divided. And so, yeah, I think if we bring down the whole house of cards, blame it on someone else, Putin, Xi Jinping, and OPEC and the BRICS, issue a new system that is largely owed to the American public. Yeah, and now you unify. Okay, great. You have a common thing to unify against. But I don't think that takes away how you get to that point of unification. You still have to hit rock bottom first, and that's what I think we're really getting at here.
Andy, we'll see each other next at the end of January at a conference in Vancouver. Do you think something will break until then?
I do. I think you're going to see a bank fail, and I think when the bank fails, it will be bailed in, and I think that's when things get really, really crazy, because the public doesn't understand that. And when the Dodd-Frank Act was written into law as a response to the 2008 financial crisis, bank bailouts were made illegal. This is why there was such outrage when Silicon Valley Bank was bailed out. And it was supposed to be bailed in, but it wasn't. They had 10 checking accounts for 3 years, checking accounts in 2020, 21, 22, with on average 1.4 billion in each one of those checking accounts. Now, where the hell was risk management of the bank, of those corporations, and of the FDIC having 14 billion earning zero interest with no FDIC insurance above 250,000 per 10 accounts? So 2.5 million in insurance behind 14 billion in 10 checking accounts earning zero. And they were bailed out? Really? I mean, there's a fine line between conspiracy and reality in everything we talk about. But all I can simply say to you is this, that if they want to call the banks and issue that CBDC to a handful of banks rather than to 4,500, yeah, let there be a bail-in and watch. 98% of the people in this country have no idea what that means. And when people lose everything, you will see everyone run to the banks to yank their money out. What's that going to do to the 10-year yield? Remember, these banks are all choking on 10-year treasuries that they don't want to sell. They're called unrealized losses. They haven't been marked to market yet. What happens when everyone runs to get their deposits? They have to sell those treasuries to meet redemption demands. Bang! The bank collapses, as do many other banks, as rates go higher and higher and higher and higher, as they're forced to dump their 10-year treasuries. This is a doom loop. And the fact that we're in this sweet spot right now where people don't get it is the most frightening thing of all, because it will catch, I think, virtually everyone completely and totally off guard and by surprise. And when we talk about the sanctity and safety of FDIC, Kai, it has 128 billion in assets backing 18 trillion in deposits. That's like a piece of dental floss acting as a net underneath the high rope. Good luck hitting the dental floss, because it's less than one. It's like a fifth of 1%. So this whole system is not as stable as we are being led to believe. And I think that's why we talk about gold and silver. To me, it's not an investment. It's not wealth. Excuse me. It's not to get wealthy. It is wealth. And that's why you own it. It's outlived everything that's ever happened in this world, from hyperinflation to world wars to pandemics and everything in between. And the biggest money in the world, who know the playbook, the central banks, are using the suppression and the rhetoric of the West to reposition without anyone noticing. And I notice, but very few people are noticing. And that's why when they finally do say, oh my gosh, I need some gold and silver, at that point, it will be, Katie bar the doors. There won't be anything left to find when the public, who has no exposure into this, runs to get whatever that isn't nailed down.
Absolutely. Andy, extremely insightful conversation as always. We always run long. I could chat with you so much longer.
Yeah, likewise, man. I appreciate it.
Really appreciate your time and
We'll have to do
your
one
insights.
this time. I won't leave you hanging in Vancouver. We'll do one in person. And look, if the world dictates us getting back together before then, I'm always happy to talk with someone like yourself who's with it, who's like-minded, who gets it, who understands both sides, and is trying to present a fair and balanced viewpoint on it. And I wish there was more balance in the way I looked at the world. There isn't anymore. Hopefully that changes. But until then, I hope you stay well, and I'll look forward to picking up where we left off.
Thanks so much, Andy. Thank you so much for your time. And where can we find more of you, by the way, before we switch off?
You can always reach us at info@milesfranklin with any questions or want prices, which will be a better price list than what you see on our website, which is milesfranklin.com. I at 4:30 today have my IT guy coming over here to help me set up my system, so I can start doing podcasts too. And I'll have you on and ask you some questions, and we can wrap. But I'm going to start doing podcasts myself. There's thousands of them out there that I've done over the last 4 years with people like yourself, and I'll continue to do that. But I'm also going to start doing my own. So finding me's not hard. Google my name. But I'm always happy to respond to emails or any questions, and or come back on your show at the blink of an
Fantastic.
eye.
Awesome. Andy, thank you so much for your time, and to everybody else, thank you so much for tuning in. We hope you found this conversation as interesting and as insightful as I did. If you did, leave a comment, leave a like. We do want to hear from you. A, we're just curious what you think, and B, of course, it helps us broaden the reach of our videos so we can bring guests like Andy back on more regularly, and guests, of course, of other great caliber as well. Hit that like button and smash that subscribe button, because I know 80 to 85% of you watching are not subscribed. Kindly change that. It is highly appreciated so we can keep bringing you content like this in the future as well. Thank you so much for tuning in. We'll be back with lots more in the future, and see you soon.